So today we're going to expose 4 very risky companies.
Right, I want to make money while I sleep. Warren Buffett said if you can't figure out how to do that, you're going to work until you die.
Why would you want to buy a company that cuts the dividend more than they grows the dividend?
Please just avoid these traps. This is how you ruin a retirement.
Ask yourself, is the thrill of victory worth the agony of defeat? Hello everyone, it's Brad Thomas and welcome back to the White Moat Show. I'm joined today with my co-host, Nicholas Ward. Nick, it's great to see you again.
Yeah, great to see you, Brad. Feels a little lonely this week without Chuck, but that's okay. I'm glad, we got a lot of views, a lot of subscribers on that last video, so I'm glad people like that. We will do our best to get Mr. Valuation back on the channel as soon as we can, but this week it's just Brad and I, but I think we got a pretty interesting topic to discuss, Brad, about speculation this week.
Yeah, so of course, last week Chuck gave us a master class on earnings. And while earnings is so important in terms of evaluating quality stocks, if you haven't watched that video, make sure you go back and watch the edition last week. But this week, we're going the opposite direction. We're going to focus on 4 companies that we think you should avoid really at all costs. And we're going to show you why. And why those companies, why earnings is extremely important in terms of an indication of the financial health of a company.
Yeah, and before we get into those 4 companies, we'll talk about it from a macro scale. Just spoiler alert, we're talking about chasing yield this week, right? A lot of people hear the word speculation and they think about, the highest implied volatility stocks. I got the list up right here for today: CoreWeave, Hem and Hers, D-Wave, something called Regicel Bioscience Holdings, right? These are the types of things. Sure, maybe you make a ton of money in the short term, but they're not really based upon earnings growth like we talked about last week. They're based upon just high expectations moving forward. But there's another type of speculation, Brad, that I think a lot of people that even consider themselves to be conservative investors kind of get sucked into, and it's not chasing these high growth stocks. It's chasing yield. It's chasing double-digit yield, either because they're greedy or because they have to. So we want to talk about why we think you should never do that, and then give some examples on kind of how to avoid the yield chasing pitfalls that we see so many investors fall into.
Yeah, Nick, back before I was a financial writer, a Wall Street writer, I was a real estate developer. And back in those days when I was much younger and closer to your age, or even younger than that, I really never knew the concept of risk. I really never thought about risk. And how risk is so important. Analyzing risk is so important to performance, financial performance of either a building that I was building or a stock that I'm buying or a stock that I'm avoiding. And so back when I was pivoting from a real estate developer to a writer, I read and reread many books. The Intelligent Investor with Benjamin Graham, which is a great book that I would recommend anybody read. And throughout that book, Graham really analyzes and talks about risk and how to mitigate risk in a concept called the margin of safety. There's another great book that's a short book that I refer to a lot. And it was written about the same time that Benjamin Graham wrote his book. This author's a guy by the name of Frank J. Williams. A lot of people probably never heard of Frank J. Williams, but he wrote this little small book. And I actually got an original copy back at my place. And it's called "If You Must Speculate, Learn the Rules." Now, there's a couple lines I want to read to you real quick before we dive into these stocks. The first quote is, "The creed of the new speculator is, I want to make a lot of money on little capital in a short time without working for it. This is just as impossible in Wall Street as it is in any other place." He goes on to say, "If you're intelligent, the market will teach you caution and fortitude, sharpen your wits, and reduce your pride. If you're foolish and refuse to learn a lesson, it will ridicule you, laugh you to scorn, break you, and toss you to the rubbish heap. The stock market is cruel, but it's glorious, representing all that we admire in the American character, courage, vitality, forethought, vision, and enterprise. This line right here. I tell all of my kids. They're adults now, but I tell all my kids, people certainly should not speculate until they have paid the landlord, the butcher, and the tailor. They should have no doctor's bills or insurance premiums overdue. Now, there you go. The game is about risk tolerance and understanding the risk that you take when you're investing in the stock market. So today we're going to expose 4 very risky companies that I would avoid, again, at all costs.
Yeah, and I think when you're reading this quote, something that came up to me, the idea of making money without working, right? That's a big thing today. Passive income. We talk about passive income every week, but we're not chasing the yield. We're generating very safe and reliable income. There's a lot of people that love that idea, and I do too, right? I want to make money while I sleep. Warren Buffett said, if you can't figure out how to do that, you're going to work until you die. I don't want to do that either. I'd rather retire early, enjoy time with my family. But the thing is, there is no really true passive income from a risk-free standpoint. There's always risk involved. Like you said, it's all about risk tolerance, right? Coca-Cola has a very different risk profile than, like a BDC yielding 10%, right? And people need to figure out where they need to fall on that risk profile, but they need to understand there is no such thing as just risk-free passive income. Maybe with short-term U.S. Treasury bonds, if you don't think the U.S. is ever going to default, but that's something. So many people get sucked into that passive income idea, but there's always some work to be done. There's always some risk to be taken. And that's what we're going to talk about today, how not to get sucked into these very high yielding ideas, right? I think you and I agree, Brad, between 3 and 6%, you can find pretty safe yields, and you can find safe yields that are growing at an acceptable rate, 2 times, 3 times the rate of inflation, meaning that over time, your purchasing power will actually expand. It won't erode away. But when you get into much higher than that, you run the risk of dividend cuts, and that is going to be the worst possible thing for somebody relying on passive income, and especially in retirement on a fixed income where they don't have the investment dollars or the time to kind of make up for those mistakes.
Absolutely. And again, anytime you approach that double-digit yield, it's dangerous. For the most of the time, it's dangerous, especially the higher that yield, the more dangerous that company. So we're going to start with the first one. This is a very high yielding company called Sachem Capital. The ticker symbol is SACH. We're going to pull that fast graphs up here in just a minute. Sachem is basically a mortgage lender. They make loans, commercial mortgage loans, the fix and flippers, quick little apartment complex, some duplexes, small shopping centers. They've got 226 loans in the portfolio in 15 states with an average loan size of about $2.1 million. Now, this is important. The average portfolio yield, this is actually the money they deploy and they get back. So their return on yield is 13%. So think about it like this. They're loaning money out at 13%. The dividend yield is 17%. How is that true? So what's happening here is they've had a number of defaults. Now, as you can see on this screen, this company is like a roller coaster ride. The earnings stream, which is the dark green area you can see on the fast graph, it starts to grow, but right after COVID, it just falls off to the bottom. I mean, the lending business just gets out of control. These fix and flippers dry up and they have defaults. So when you have defaults, which you're going to have defaults, anytime you loan money out at 10, 11, 12, 13, 14%, anything in that range, you're going to have default, no question. So this company saw defaults of about $124 million in the first quarter. I think we're going to have these results out this week, today or tomorrow. So we'll kind of see how bad those defaults are. But just take a look. I've got labeled in here. They had a dividend cut, they had another dividend cut, and very likely they're going to have another 1 or 2 more dividend cuts. So just be careful. This 17% yield is absolutely not sustainable.
So why do they, if I want to buy another house tomorrow, I can go to a bank, call it my mortgage guy. I can get a loan 6.5% ish. Why are these people having to take these 13, 14% yields that this company's paying out? Do they just have terrible credit scores? What's going on here?
Yeah, that's a great question. And I've actually talked to the company a good bit. Not recently. My former source was a CFO who's no longer there. And that's another thing. They've had a little revolving door of management teams. But I've been in touch with the company quite a bit over the years. And yeah, they do evaluate, they do manage risk. They look for credit scores and they look at the credit worthiness of the company and the track record of the developer or the borrower. But in this case, I think a large part of this has to do with a lot of these loans are made to, think about it like me, Nick. When I was a developer, I was starting up and I needed like some help. So I went to a business partner and I said, hey, I'll do all the heavy lifting. I'll put all the sweat equity in the deal. I'll go find the deal. I'll hire the contractors. I'll oversee the product. But I just don't have the capital. So I went to a partner and I just said, hey, I'll do a 50-50 deal with you. If we go in and we build this building, we sell it, we can divide it up 50-50. That's what I did. What a lot of these people do is it's a lot cheaper to pay 13% to a bank or to a mortgage REIT than 50% to a business partner. So
yeah, it makes sense. Yeah.
So that's I think a good example of a customer for them. Maybe it's a home builder who's just starting out and he didn't want to go to an expensive equity partner, so he's going to go pay 13%. And again, it's all timing. They try to get in and out of these loans within a year period so they can move on to the next deal. So anyway, that's Sachem. Avoid that one. The next one, and I'm not going to call anybody out, but Nick, you and I were on Seeking Alpha for a long time, and over the 15 years that I've been on Seeking Alpha, I've seen a number of writers, writing about yield, chasing this yield. And this company I'm going to tell you about in a minute, Agony Capital. I just saw it this week. In fact, today, there's an article that goes out on Agony Capital. Ticker symbol is NLY. Company's yielding 13.7%. That's not sustainable. Now, what Agony does at a high level, they're a residential mortgage REIT. They have a portfolio of just under $90 billion. So a very sizable portfolio of residential loans. Now, that's broken down between the agency loans, which invest in primarily securities that are backed by Fannie Mae, Freddie Mac, and Ginnie Mae. And by the way, that's a risk because we know that Fannie Mae and Freddie Mac could be privatized. But anyway, that's $80 billion, that capital that's sitting there. They've got residential credit loans, $6.6 billion. And by the way, you just saw the jobs numbers last week. So there's still some growing instability in the housing market. So that's another risk. And then the other component they've got is mortgage servicing, which basically provides service to residential loans in exchange for a fixed fee. And that's about $3.3 billion of the business. Now, I mentioned earlier, their yield on cost, this is their levered yield on cost, is around 16 and 19% for agency, around 15% for residential credit, and around 13% for MSR. So they're averaging about 15% levered returns. And this is the important part. And this is what I learned as a developer, why leverage can be extremely dangerous. Agony carries debt of about $88.8 billion. Their debt to equity ratio is a very unhealthy 678%. Now, take a look at this fast graphs. All I need is one picture to show you why to avoid Agony. Look at all these dividend cuts. This is a chronic dividend cutter. I think I added up. There's 9 or 10 dividend cuts over about a, 16 or 17 year period. They cut the dividend more than they raise the dividend. Why would you want to buy a company that cuts the dividend more than they grows the dividend? That should be simple. So please don't chase that. What is that? A 13.7% yield. Stay away.
Well, and here's what happens with this. We've talked about Agony several times. Their management team might get angry at our YouTube channel. I don't know. We're not big fans. Here's what happens, though. You've got a 13% yield. They cut the dividend. The stock falls 15%. Then what's the yield look like? It looks like it's about the same. I've seen people say this all the time. Well, they cut the dividend, but guess what? I've still got a 10% yield, but you just lost 20% of your capital. So sure, you're yielding, but your yield on cost is really all that matters. We want to see yield on cost is rising over time. I talk about it all the time. Nick, why would you buy this company that yields 1%? Well, my answer, it's growing at 15% a year. In 20 years, my yield on cost is going to be like 10% on that company. I'll be making 10% of my original investment every year in dividends on these high compounders. Agony is the other way. I just looked it up using fast graphs as well. If you bought this stock 10 years ago, they were yielding $4.80 a share. At the time, you had a 12% dividend yield. Great, right? You're thinking that's wonderful. I can pay my bills, etc. But like you said, they've had all those dividend cuts. So what's that yield on cost today? It's only 6.5%. So you've lost a lot of money and your yield on cost is half of what it was before. We talk about inflation a lot. We want to see our yields on cost and our dividends growing because think of all the inflation that's happened since 2014. You need to see a much higher yield on cost on what you bought then today just to break even. Well, annually, you got cut in half by dividend cuts and probably cut in half again by inflation. Your purchasing power here is not good. That's not how you have a comfortable retirement. So yeah, don't fall into that trap, right? The dividend yield's still 10%. Well, it's 10% because the share price fell. That's not what anybody would want to see. So you got to look at more than dividend yield. Look at why it is where it is, and just avoid these traps. This is how you ruin a retirement. You don't retire comfortably with stocks like this. You need help from your children.
Yeah. Well, the last stock here is one actually that I've recommended in the past, but now I'm avoiding this company. This is an interesting company, Innovative Industrial. This is a cannabis landlord. They're an equity REIT, so they own buildings. Ticker symbol for Innovative is IIPR, and the yield is a big fat 14.8%. Now, this company was founded in 2016, and actually they were the first mover. They have the first mover advantage in the cannabis landlording space, and they're the only cannabis REIT that's listed on New York Stock Exchange. They got in the window before it closed, and so all the other cannabis players are all either over the counter or on NASDAQ. Now, they have a pretty massive portfolio. They've got about 108 buildings, which is about 9 million square feet in 19 states. So they built some scale over the years. What's really interesting about the company, though, we mentioned leverage before, how annually was extremely leveraged. Well, IIPR is not. IIPR has actually one of the lowest leverage ratios of any public REITs. They only have 11% debt to total gross assets and about $220 million of liquidity. Now, what I want to point out, though, and this is something we all have to look for as analysts or investors, the payout ratio for Innovative, IIPR, was around 80 to 85% historically since the company listed, again, on the New York Stock Exchange. However, in the first quarter, they haven't reported second quarter yet, but in the first quarter, they generated about $1.94 in earnings, and that's adjusted funds from operation. That's down 13% from the fourth quarter. Now, that puts the payout ratio at $1.90 dividend. That puts the payout ratio at around 98%. So there is basically no margin of safety. Let's pull up the fast graphs here. You can see, now we recommended the company when they were in this huge growth mode. I mean, they were generating earnings of 100% and 50% and 60%. So there's some investors that made a lot of money on that climb up when cannabis was just taking off. And now we've got a lot more competition. The market has changed. There's a number of defaults. There's a lot of risk more in this. Also, the fact that we still don't have federalization within cannabis. So it's a state by state, basis, which there are more states opening up. But as you can see from fast graphs, their earnings has flattened. In fact, it's declined, and their earnings have declined so much that now that dividend yield is not safe. So even though we've recommended this company in the past, we're saying hold up now, because I believe there'll be a dividend cut very soon. This year, probably most likely next year. So I think you're going to see between 25 and 26. You'll see IIP cut the dividend. Even though the company has very low leverage, they just don't have enough earnings to support that dividend.
Yeah, and I don't want to kind of toot our own horn here, but I do think that's why it's important to have people like Brad or like me on your side here. We publish these newsletters because we're not just picking a stock once and then just blindly owning it forever. You may have liked IIPR. I don't know. It's not something I follow. I don't know how it's done since you first recommended it. But the point is when the numbers change, when the story changes, when the facts stop lining up, we'll pivot and you get out and you save the dividend cut. When dividend cuts, stock prices generally fall. So if you're right, it may not be a good time to own IIPR. We've done that in the same thing. We've gotten out of companies like Nike, Target. It comes to mind as companies that we think it's a deep value. Then all of a sudden you start to understand, hey, maybe this isn't the story I thought it was, right? So that takes a kind of an analyst that's really staying on top of a company to do that. So, and it takes humility, right? I know you've written a lot about IIPR. I'm surprised to hear them on the avoid list because I know that's something you were bullish on in the past. But yeah, if you think a dividend cut's coming, I totally agree. There's no reason to kind of speculate and hope. Hope is not a strategy, right? Just follow the numbers, and there's got to be other opportunities. Maybe not at a 13% yield, but that's the point here, right? If the stock's yield is that high, it's that high for a reason. The market's not stupid. it's irrational sometimes. But when you can get 4 to 5% with T-bills and there's 15% dividend yield on the stock, there's got to be a major problem somewhere under the hood.
Speaking of opportunities, Nick and I have discussed next week, we're going to show you some opportunities. We're going to show you companies that are higher yielding, because we know everybody likes high yield. Who doesn't, right? But we also want to have safe high yield. So we're going to show you some of those ideas next week. But before we end this show, I want to show you one more chart. And last week, pulling up right now, Realty Income, ticker symbol O. We talked about Realty Income last week. Chuck Carnevale was extremely bullish, as Nick and I are on Realty Income. And the only reason I'm pointing that out, I'm not going to show you this stock every single week, but this is to compare. I just showed you 4 fast graphs that basically look like roller coaster rides. They were up and down and dividend cuts and possible dividend cuts. The earnings weren't growing. Just take a look at this fast graph, this chart. The dark green area shaded has earnings growth, consistent, reliable, predictable earnings growth. On top of that, which is the light green or the lime, I call it, shaded area, that's the dividend stacked right on top. So you have very reliable and growing dividends. In fact, this is a dividend aristocrat, so it's over 25 years in a row. In fact, they've increased dividend 30 years in a row. So this is just an example of a company. Now, they're not yielding 10% or higher. They're yielding around 5.5%, I think, today, 5.7% today. But look at this earnings growth. So the key is look for safe and growing dividends and earnings and make sure that dividend is safe and the company is not robbing from Peter to pay Paul. I had a good friend of mine years ago, and he said this, I'll never forget. He said to me, Brad, you have to always assess risk. Ask yourself, is the thrill of victory worth the agony of defeat? And every time you make a trade, always ask yourself that question before you say buy. Ask yourself, is the thrill of victory worth the agony of defeat?
Yeah, no, I would say no. I'm coaching football this fall, as you know, Brad. Our first practice is today. So I was on Netflix last night. I watched the Swamp, the Florida Gators documentary they had from a few years ago. And one of the players said, Urban Meyer's the most competitive man I've ever met. He hates losing more than he likes winning. And that's what drives him. Not the thrill of victory, but he hates losing. And I think we're pretty similar at Wide Moat, right? I don't need to hit a home run, but man, I hate striking out so much. That's not what I want to do. Our portfolios do very well because of that kind of mindset. And like Brad said, so with that in mind, next week we will show some opportunities we'd like with higher yield. And I think I'll probably end up discussing kind of my passive income oriented option strategy. So if you guys like options trading, that will be discussed, I think, for the first time on the Wide Moat channel next week. So stay tuned on next Thursday, I think 11 a.m. And, you guys will get some actionable ideas. So thank you guys for joining us today. If you like this episode, please like and subscribe. Leave a comment below. We always respond. And I'll seal Brad's sign off. Happy Swan investing, everybody.
Thanks for watching this episode of The Wide Moat Show. Please like and subscribe below. And also, please join us at the Wide Moat Daily for our dose of daily news. You can visit us at widemoatdaily.com. Thanks for watching us. Have a great day.